Bank of America has warned that we are on the verge of a full-blown recession. Recently, an insider in Bank of America, meaning someone who is a high official in Bank of America, sold off 50% of his shares within the past year. And also for the Bank of America Corporation, most insiders were actually net sellers compared to net buyers, meaning that there were more people selling shares than people buying shares. Now, people did buy shares, but not at the same rate or not as much as people were selling their shares. And I think that tells a lot about what Bank of America is thinking about the economy. And recently I read this great article that I missed that just had a ton of different charts showing how we are getting closer and closer to a financial crisis and to the economy going into a deep recession. All right, so looking at this chart right here, Bank of America here is saying that we're on the verge of a full-blown recession. There are plenty of signals that suggest a recession has not been avoided. And the first indicator that they pointed out was the decline in manufacturing activity. The first indicator that they pointed out was a decline in manufacturing activity. And so here they're showing a decrease in manufacturing activity. And before that, it happened during the pandemic with this big dip happening. And so you see that happen in 07 and 08, where it went down below, I guess, this line, which really showed a deep recession happening. Right now, we're on the verge of that. And if it goes lower than that point, then we know we have some shaky times coming our way. And you even see that in the housing market. You see more people like slowing down their new construction or investors not buying as much. In turn, that slows down the production of different materials needed in order to build and make a house. I think this is an interesting chart showing that, I guess, once it goes below that 45 number, then we have some serious issues. The other thing is that a decline in manufacturing often coincides with lower earnings. And so with lower manufacturing, obviously the global GDP, we're not making as much money. Companies are not giving as much dividends and things of that nature. And all of that has a big impact on the economy. The other thing that they talked about that I wanted to point out was they have a lot of different indicators here. They have 12 different indicators. But one thing that I wanted to point out was the price of oil showing concerns of a recession. So we know that gas prices usually follow right into a recession, right? It says oil prices historically rise into recessions and decline during recessions. And so you see that we did reach our peak sometime last year, but it's still at elevated prices, right? It goes down a little bit and then it may still go up higher. And so the higher of these oil prices that we have, the more of an indicator we know that we are reaching a recession. And it's crazy that one of the largest banks in the world is showing this, Bank of America. The jobs market often follows manufacturing activity. So obviously, since you're not manufacturing as much, you're not needing to hire as much people, right? And so you see that weak ISM manufacturing PMI suggests U.S. labor market will weaken the next few months. Adding that it viewed February March job report as the last strong payroll reports of 2023. So yeah, we did show strong performance in the labor market on these past couple of months, but a lot of experts are saying that's going to be the strongest for this year. And then in the summer and later down this year is going to decline. All right, so the next thing is global home prices falling. And we're still not there yet, but home prices have been starting to decline some bit. Now, they're not at the point where it's affordable for most people because of mortgage rates, but we're still seeing a decline in home prices. The more we see of that, the more we know, okay, we're entering into recession. We're entering into a time where the economy is definitely slowing down. All right, a credit crunch will hurt the job market. So U.S. banks have been tightening their lending standards to small companies the past few quarters. And this is a huge deal, like this credit crunch. And we're going to talk about that more in today's video. Like a lot of these banks are dealing with this fear that, okay, we don't know what's going to happen in the economy. We don't even know if our customers are going to pay us back the money that we lend out to them. And so we're going to make lending even stricter, even harder for people to obtain loans. And we're not going to give as much loans as we used to because interest rates are high. It's just more expensive for our customer. So in turn, these small businesses, different companies don't have as much money to invest into the market, into the economy, which grows the GDP. And so so small businesses don't have the funds or resources to build their business, which will bring the economy down. And you see that happening across the board. You see that with the recent bank failures and this recent bank failure with First Republic that JP Morgan just bought out. And we'll talk about the credit crunch right now because I think that's something we need to talk about. So here saying that almost half of America's 4,800 banks are already burning through their capital buffers. So on top of, limiting the amount of lending that they're doing, a lot of banks are now burning through their capital buffers, right? That extra money they have just in case of emergencies. Half of them are going through that money currently. A lot of banks too are currently sitting on assets worth less than their liabilities. And so they're in a negative net worth position. Besides, the FDIC has only $127 billion of assets, and less very soon, and may ultimately require its own bailout. So the FDIC that insures banks if they have a fallout, if they run out of money, the FDIC, how can they lend to people or give money to people who have their deposits in these different banks and these banks are failing, right? The FDIC cannot insure every single bank $250,000 if they themselves don't have the amount of money to give to people in case of those emergencies. So these are huge issues coming to the economy that these different banks are talking about that has a huge impact on the economy. First Republic lends to technology startups, but it chiefly came unstuck on commercial real estate. And so that's the big thing. Yeah, First Republic, they were kind of like Silicon Valley where they had a lot of customers in the tech field. But the thing with their fallout was commercial real estate, the thing that we're talking about recently. And more banks are going to experience this that are not related to tech startups or the tech industry, but just related to regular real estate like all of us know, and which is the foundation of the economy. And once again, $4 to $5 trillion of debt in commercial property sectors are essentially due pretty soon. About $1 trillion is maturing in the next 12 to 18 months. And so you have a lot of these issues happening in the economy with this credit crunch, with banks being fearful and customers not able to pay off their loans, debts are maturing. And so we're just brewing like this perfect storm about to happen in the US economy. And a lot of banks are warning this. Now, Mohamed El-Erian, one of the well-known economists of our generation, he has put warnings on what happened with First Republic and just this takeover of JP Morgan Chase of First Republic. First of all, no one wanted to buy this failed bank because they failed because of commercial real estate. But JP Morgan Chase and Bank of America was bidding because eventually the Fed, the government, just gave a lot of subsidies for bigger banks to buy this bank. And so it was a good deal for them. But a lot of banks were steering clear of trying to buy out this bank. But here are some consequences of this that this expert believes. So first of all, like this too big to fail notion of banks falling or failing is out of the picture, is what this expert is saying, which makes sense. And he believes that now it's going to be too big to manage, right? And so you can imagine, like, just think about Chase, Bank of America, Citigroup, Wells Fargo. Imagine one of these banks failing. And we always thought, oh, they're too big to fail. If one of these big banks fail, the economy is essentially into a depression, most likely. It's not going to be the best state. It might even be worse than the 2007-2008 financial crisis. He says such institutions are so large and crucial to the financial system that their fall would have disastrous impacts on the economy. His second point of this whole effect of First Republic and JP Morgan Chase buying it is that there's even greater doubt about the nature of the de facto deposit insurance system in place. And so I talked about how the FDIC only have a certain amount of assets on their account. And so like this deposit insurance system in place is not 100% guaranteed. And then third, the risk within the banking system of less credit extending into the economy will continue, potentially aggravating the headwinds to high and inclusive growth. So it's just showing that the more of this credit crunch that's happening, it's not going to go to these small businesses that are probably the backbone of the US economy, right? People like you and me, like investing in our 1 or 2 rental properties, right? We're not no big time landlords, or like a small coffee shop or a person that owns 2 or 3 chain restaurants around a certain town, right? These type of businesses are going away because banks are not lending to these type of consumers, right? And so you're seeing more of this issue happening, and a lot of banks just be super inclusive, just lending to people that are tried and trusted, to these bigger banks, to these bigger corporations. But people like me and you are missing out, and which in turn affects the bigger institutions, because now we don't have as much money to buy or do business with these bigger companies. Finally, the total cost of First Republic resolution remains to be assessed, including how the burden be shared among the public and private sectors, and with that, the extent of bailout for the 11 banks that had large deposits with First Republic. Yeah, it's just showing that here we don't know like how much total of the assets is the value of this particular bank, and the extent of the bailout for 11 banks that had large deposits with the First Republic, because First Republic took deposits of other large banks. So what's going to happen with those deposits? Are they going to get 100%? Half of that? What's going to happen with that? And so a lot of these issues are brewing in the economy with this banking collapse and what Bank of America is seeing, like the different indicators happening. And so I want to really highlight that credit crunch because I think that's super serious. All right, so the last 2 indicators I just want to highlight that Bank of America was talking about is that stocks drop after last Fed rate hike and inflationary period. So the last time the Fed hikes the interest rates, that's when stocks will completely plummet. And so I don't know if that's going to be later this year, sometime next year, but that's usually the time to sell your stocks. And usually that time, yeah, stocks plummet. And so sell the last hike was a correct strategy for stocks in inflationary period, 70s and 80s, and then buy the last hike worked in the 90s during disinflationary market when inflation was actually down and there was no growth in the economy. Stocks in recessions don't mix well. So usually when stocks recessions reliably negative for equities throughout history and is sufficiently discounted in advance, plenty of room for more S&P 500 downside. All right, let me know your thoughts down below. I think this is super interesting, just hearing from Bank of America and learning more about this credit crunch that I really highlighted in today's video. What are your thoughts down below? Be sure to subscribe, like this video, and I'll talk to y'all later.